Well, folks, we just had another in a long series of inflation readings come in hot. We've got an important number tomorrow for CPI and retail sales. We got to talk with Anna. What is going on? Is the Fed lost control of inflation? What do you think, Anna?
I do think the Fed has lost control of
Oh
inflation
no! Oh,
just
that's not good.
to some extent. Okay. Um, Here's the thing with inflation. Yes, PPI just came out a little bit higher, and PPI is basically the wholesale input cost that producers have that they
Mhm.
typically try to pass through in their prices to the consumer. So if we see PPI going up, it could be a hint that they're going to be raising prices to keep up with that increase in their costs, and therefore it could mean that CPI will then come up higher. It's not going to be the CPI report that comes out this week, tomorrow, because it hasn't trickled through into that. So there's a lag effect between the time that PPI goes up and then it gets passed through into costs and the CPI goes up. So it went up slightly, depending on how you define slightly. There was an expectation of 0.2% and it was 0.5%. So it was more than double the
Double, yeah.
expectation.
That's
But it
that's
was,
100%, Anna.
yeah, exactly. But on an annualized basis, it's still about 2.2%, which is better than, where it had been, and signs that at least on an annual basis, it's coming down. The question is, will producers be able to pass through that increased cost in their profits, or are they going to have to take a profit hit because the consumer's so tapped out that they just say, Uncle, we won't buy anymore? Similar to what we're seeing in the recent reports from Starbucks and McDonald's, Walmart, et cetera, that says people are just not able to accept these, price increases. Look at Tyson. Something that when we talk about that the Fed lose control, something that CPI has that drives me nuts is a replacement factor. So like instead of tracking the replacement costs of, how much more does it cost now to buy beef? They say, well, the consumer will just switch to chicken. So we'll just look at the price of chicken increase instead of the price of beef increase. Really, both are now suffering. So people aren't even buying chicken now. So Tyson's announced this, really poor outlook for the future, saying, and laying off people, saying people aren't buying chicken. They're not even buying that protein because the costs of everything else are going up. So PPI, it's kind of I thought the stock market would be more reactive today than it has been so far, but it's kind of one of these things that says it's still relatively low. Let's just wait and see what happens with CPI before we determine whether this means there's more inflation coming or that the Fed isn't going to be able to get inflation down.
Yeah. PPI is always like the appetizer to what will be CPI tomorrow. And you're absolutely right. Companies have options, right? They can always collapse margins. A lot of companies are running at record margins, right? So a lot of that could just be absorbed perhaps there. The other thing that I actually think retail sales tomorrow is a more important number. And I mean, for years, I know 18 months, inflation's been everything. I think retail
Yeah.
sales is important because right now I think retail sales are expected to be up slightly. I actually fear they're gonna be down, like, over 1%. We're gonna find out if the consumer's truly tapped out tomorrow, right? You saw, like you
Right.
said, Starbucks, McDonald's, also
Hmm.
Lululemon, right? Kind of both extremes, right? The kind of truly discretionary and kind of, people trading down from McDonald's to eating at home. Um, I think retail sales could be spectacularly weak tomorrow, which
Yeah.
will give the Fed cover. Because again, this is really bad. I actually think given the base effect, the small base effect with CPI, inflation's gonna tick up tomorrow. And the market is set up for CPI to go down. So it could be
Yeah.
so if I think there's a chance that CPI is flat or up, which is not what the market expects tomorrow, and we have weak retail sales.
Yeah.
That could be a disaster.
It could be. And this is, I mean, definitely there's things that are surprising me when I see numbers. And then when I dig into the data, it's like, oh, well, this makes sense, right? So one of those things, to your point, is retail sales. Now, if you really look at retail sales, all they show us is the dollar amount of retail sales. What they fail to do, though, is show the change in the
Units,
units of things
right?
that are bought. And although retail sales dollars are up, the cost of everything's up. So the amount of things actually purchased has gone down. So when you dig into those numbers, it's never what's talked about on the media, even financial channels. I'm not sure why, but they're just saying, well, if the consumer's still spending more money, they must be strong. But the reality is a lot of the retail sales they're buying less stuff at a higher price. So the more that less stuff comes down, retail sales will start to come down a little bit. And I think that, if you look into, I try to go back to the consumer and say, how is the consumer? The media says the consumer is healthy, the economy is strong. 70% of GDP, a portion of that, which is retail sales, is from consumer spending. So if you want to look at where are things heading, you have to look at where is the consumer today versus where were they before. Because the CPI number that comes out, Michael, is basically a lag effect of where the consumer was. It doesn't tell you where the consumer is and where it's going. So if you look at the consumer, you can see that the consumer has spent down all of our post-COVID savings. Everything that was the helicopter money, it's been spent. And the consumer has ticked up their credit cards. Now they're maxing out. And we have now the highest defaults in credit card debt since we've had in 2011, post-GFC. So the consumer as a whole is struggling. Within that, however, you have a very bifurcated economy, like you and I have talked about, where the wealthy continue to spend, but the average American family is tapped out and they're pulling back on spending. You look at restaurants, as part of that services inflation. Restaurant sales have actually been hit hard. And, we talked about Starbucks and McDonald's, for example, but there is actually less restaurant income right now than there was January of 2021 post-COVID. So when you start to see people are not eating out as much, now they are at the high end, but not at the lower end because they can't anymore. They've tapped out their credit cards and they're not even buying protein and chicken at the grocery store. It tells you that the consumer as a whole is so tapped out that should lead to lower retail sales and lower CPI. But when you look at the CPI numbers, the complexity, and this is why it's so hard to figure out where are we going to be quarter by quarter. I can tell you over the longer term, recession, no doubt in my mind, right? Because there just isn't enough to keep the consumer spending. They're struggling already. They're just going to continue to struggle more as layoffs increase. But what you have is when you break down the components of CPI and growth, GDP, growth was primarily stimulated the last quarter by government spending, a huge uptick in government spending that then trickled into creating more wage growth in the government sector. So when you look at jobs and wages, job growth is declining. Services sector, manufacturing sector, as we saw a couple of weeks ago when the data came out, are actually laying off. So you see a higher uptick in unemployment, underemployment, lower wage growth. But yet in healthcare and government, they're making more money. So they're spending more, they're paying their workers more, but it's all public sector generated growth, not private sector. So when the government starts to spend, and oh, by the way, we have to pay for it with higher tax dollars later that are also going to reduce consumers' ability to keep spending, you start to see a bifurcated economy that makes it really hard to say what's going to happen next quarter. Once I see the print, I can go, oh, it's higher because all of the growth was in food, insurance, healthcare, owner's equivalent rent, or it was in government spending and government wages. Those sectors are going to continue to be inflationary. It doesn't mean the consumer is healthy and we're going to see higher growth and higher retail sales. I don't think we are. I think inflation is going to continue to be pushed down in the short term by the stretched consumer who is tapped out and can no longer spend on discretionary stuff when about 80% of the CPI is the stuff that they have to spend: healthcare, rent, insurance.
Well, let me just I think I share the same concern, right? I've studied the consumer specifically for 30 years since I got my econ degree. So we're totally in sync there. But starting yesterday, and at least as of right now, 8:43 Tuesday morning, it's continuing. These meme stocks, AMC, GameStop. And the reason I want to bring this up is there's been there's been talk of the death of the consumer, the death of the retail trader for a long time. Well, Anna, they found money somewhere. They found money. There's clearly money in the system to see them push these two stocks that high that quickly. Short sellers lost $2 billion in less than 2 trading days. So
Yeah.
I know there's a talk track that the consumer is dead, but I want to postulate that maybe not. They have money. They have money to go gambling on meme stocks.
The question is, where is that money coming from, right? So, and then what part of the consumer is actually spending it? So, it is a sad reality, but I've seen it over and over again. People going and getting a line of credit or a mortgage on their house so they can go invest.
Oh my
So,
God.
how many, there's an uptick in refinance and actually second mortgages right now, right? So, how many people, if we know, and it's hard because the average is always
See, I don't
skewed.
think I can't be lending.
Average
It
is
just can't.
skewed, Michael,
Yeah, I know,
by
I know, I know.
high-end income earners and low-end income earners. But if
Oh
you
yeah,
look at the
correct.
median household is tapped out. They have less than $1,000 saved. Just think about this. 66% of the American households have reported that they are living check to check.
Well, let me
They
ask
have
you about
less than
that. So
$1,000. Hold on
I
one second.
understand.
They have less than $1,000 and their credit cards are maxed out. So that's 66% of households. Sure, there's 34% of households that still have some savings, or they can go borrow, on leverage, or they've got a 401k that maybe is self-directed, and they're going to go, hey, I better try to make a little money on this thing. Great, that's 34% of the population, some percentage of that. That doesn't mean that the consumer is strong. We have data that shows the consumer isn't strong. Whether there is irrational exuberance and irrational behavior with money that they may or may not have, or they may be borrowing, that doesn't tell you the consumer is strong. It tells you that some people are crazy.
It's that's always been true. It's funny.
Right?
It's so true. But I study this just like you, right?
Yeah.
Consumer oriented. And when we say things like 66% of the consumers don't have $1,000 in the moment, that sounds horrible. But here's the reality. 5 years ago, 10 years ago, 15 years ago, the percent was roughly the same. It was roughly the same. I think it was like 63 or 64%. It's always been in the 60s. So people lose that. We say 66% like, oh
Sure.
my God, it was 33% a year ago. That's just not true. The
But they
American
had
consumer,
4,000 a few years ago, because I was tracking this data
but
too.
that was COVID
4,000
money.
a month in savings. Now it's or $4,000 in savings. Now it's 1,000, right?
Well,
So
yeah, we have that
it,
2 or
yeah,
3 year blip where people weren't doing this, weren't doing that. They were getting checks in the mail.
sure,
Very abnormal. But
sure.
historically speaking, the average American consumer has never had any money. Right?
Well, right, right. And the question is, are things getting better for the average American consumer, or are they getting worse? And I think if you go back and look at, this is part of the problem with inflation. And I think we might have mentioned this 2 weeks ago. Forgive me, I can't remember for sure, but I went back and looked at, what was the average wage of a production or managerial employee back over 38-year period from the 70s to 2019. It was exactly the same
Adjusted for
inflation
inflation. Yeah.
adjusted dollar amount. And so people are basically, because of inflation, just treading water. But during a period of massive amounts of inflation, they're doing worse than treading
Oh,
water. And
no
so,
question.
what we've also seen, though, over time is that the wealth gap has gotten greater and greater. So that middle class that was stronger, that really made up a large percentage of the economy, is now even smaller. So you've got more people that have a lot more money, that have really grown through not only the longest expansionary period in history, but also through all the helicopter money and inflation and our asset values going up. But the middle class is disappearing and the lower class is increasing. And so when you look at the consumer, again, the mean is skewed by the averages. So it's just like
Or
the S&P, right? You've
Mhm.
got 10% of the companies in the S&P making up about 75% of the growth of the S&P, right?
Mhm.
You look at, corporate balance sheets. I don't remember the exact number, but it's something like the top 10 have like 80% of the balance sheet, 75 or 80% of all of the other 400 in the S&P, or 400 and something. So, you know, you've got, just like in the stock market, the consumers, where there's a small majority that's doing extremely well. There's a much larger majority that's not. And all of it's put in this one pile that says the consumer is strong. Well, what consumer are you talking about? When it's
Yeah.
the majority of people, Michael, they are in a worse place today than they were in 2019. If you go back and look at their savings and their credit card debt, and their real wage growth on an inflation adjusted basis is down. They are
Oh, no question.
their household expenses are up 24% compared to 3 to 4 years ago. 24%. So if my cost of living has gone up 24% and my wage growth has not kept up with that, I am not a strong consumer. I'm sorry, you know,
Sure.
not me personally, but that's the
Yeah.
reality of the average American family. So where are they going to come up with the extra 24% growth and wage growth to make up for just getting back to where they were in 2019? I would argue that they're not. I would argue that retail sales, CPI, have to start coming down because the consumer simply cannot afford any more inflation. They are starting to pull back. And once they realize that their jobs may not be as easy to replace if they get laid off, they're going to be scared. They're going to pull back further. And I think that that's going to do some of the job of the Fed for them, and that in the future, CPI is going to start coming down because of all these lag effects of hitting the consumer hard. And now we're looking at companies not able to pass through those profits. I think the consumers are starting to pull back. And I think we're going to have a recession, which is going to bring CPI down in the short term, regardless of what tomorrow's numbers show in the CPI, because tomorrow is more reflective of the past. The consumer today is more reflective of the future. And I just think 80% of consumers, ballpark 66, 80%, somewhere in there, are stretched and can't spend anymore. And the rest of us can go buy meme stocks if we want to take some risk.
Yeah, it's going to be really interesting. I actually, over a month ago, I called out this CPI reading as the one that scared me because I thought we could be in a weakening economy. But just given how the math works and given the nothing base effect we're going to get, I've said a month ago, and I have receipts that this one I think shocks higher. But then if you roll forward just a month, it's one of the larger base effects. So we could see a head fake tomorrow, to your point,
Yeah.
just given the math, and then really see a month of, okay, the job market is truly weakening and, you know, all of those
Sure.
things. So this
Sure.
could be the last hurrah of inflation shocking higher.
Yeah.
But, you
I
know,
agree with you there. I think it's either going to I'm going to have 100% win with, right? It's either going to be lower or it's going to be higher. I mean, it's not going to be the same. I think because GDP was only 1.6% last
yeah,
quarter, I think
yeah,
it could come, you know, that again, that's kind of prefacing where inflation's going to be, because if you don't have growth, then you can't go spend money. But I do think, you know, oil increased since last month, the cost of
yeah,
oil, which is passed through in consumer
sure.
goods. Most goods inflation is very much down and most services inflation is higher. But again, when you look at the last, you know, you look at last month's PPI was revised downward, for example. And so
Sure.
most of these strong growth numbers tend to be revised downward, and we're not told about it till later.
Yeah. It's
So
a
those lag
footnote.
effects
It's a
could mean
footnote.
that it's worse. But I
Yeah.
just got a sticker shock, Michael. One of my local properties, my insurance went from 7,000 to 16,000. I was like, no way, on a small local
Yeah.
portfolio. So, you know, truly, it's almost 80% of the growth in inflation has been in owner's equivalent rent, insurance, healthcare, and then food, which we take out because it's volatile, right? So, the consumers are spending the vast majority of their money on necessities, and so they
Right.
just have to stop spending on discretionary. So I agree with you that it's possible that inflation's higher than expected for April, that when we see that print tomorrow. But I don't think that that means, oh my goodness, inflation's going to be so high, the Fed's going to keep rates higher for longer. I think because of the other, headwinds against growth, basically the jobs and the consumer, I think that that's going to pull inflation down over the next couple of months. And I think that the Fed's going to be forced to cut rates sooner than some people think.
Do
We'll
you think they
see.
cut? Do you think they cut before or after the election?
Oh, goodness. When I look back, it depends on the timing of the NBER. And let's not
Mm.
pretend anybody doesn't want to be accused of being political, right? If you go back and you look at indicators of employment, indicators of recession, by 5 or 6 historical standards, we are in a recession and have been since the fourth quarter of 2023. If the NBER comes out and declares that we're in recession, the Fed will cut.
Oh,
They
they'll
will cut
cut.
before
Yeah.
the election. If they do not, and we don't see mass layoffs quickly, although we're seeing more corporate bankruptcies than we have and more
Mhm.
job losses projected by the S&P ISM services and manufacturing
Yep.
surveys. Unless we see a big uptick in layoffs, I think that the Fed holds out as long as they can till they have 2 CPI
Yeah.
prints that are negative. But if
Yeah.
we see a big uptick in layoffs or the NBER declares recession,
Boom.
that's when the Fed says, oh no, our hands are tied. We
Yep.
have to choose. Do we allow there to be more unemployment and definitely have a recession? Or do we keep fighting inflation? The Fed wants recession. They haven't told you that, but they go back to Powell's first press conference. You and I talked about this. We
Hmm.
need the job market to come into better balance, aka we need you to lose your jobs and make less wages so you can stop spending so you can bring inflation down. This last time that Powell spoke, and you and I haven't got to speak since then, he came out and said,
Hmm.
we are focusing on our dual mandate now of
Yeah. The
employment
Fed
and
pivot has
inflation.
happened. Yep.
He's coming back to worrying about employment and saying
Yep.
jobs are coming into better balance as aka we're almost at the unemployment number over 4 that we need to be able to pivot. And so when you have an unemployment print of 4%, I don't think the Fed's going to care what month it is. I think they're going
Mm.
to go, okay, inflation's coming down enough. We have
Yeah.
high unemployment. If they get a higher unemployment and a lower CPI read together, that's going to give them what they need to cut. I don't think they do it in June. July only if unemployment really ticks up. Otherwise, I think probably you're looking at a September rate cut. That would be my guess.
There you go. Anna, you're amazing. Where can people find you?
Great. You can find me here on your show every week. You can find me at social media, Anna Kelly, REI Mom on Facebook and LinkedIn. And if you're looking for real estate wealth coaching, consulting, or investing, you can follow me at AnnaKellyInvesting.com.
Thank you so much.